One of the big stories we watched this week was some encouraging inflation trends in Canada, which all of a sudden got traders anticipating another interest rate cut from the Bank of Canada next week. Bloomberg data is suggesting now, amongst those who watch this stuff, there's a 95% chance that the Bank of Canada will follow that June cut with another 25 basis point cut today. Now, we've heard the Bank of Canada talk about how they're going to be making moves on rates depending on whether things are moving in the right direction for them. That's somewhat helpful, but if you've got to make a decision on a mortgage right now, I think you're looking for a better idea of where interest rates are going to be over the next 6 months or year, and whether you buy or look for a fixed mortgage or a variable rate mortgage. And so we wanted to talk a little bit more about this theme with two people who are experts in the field. David Larock is a mortgage broker and the owner of Integrated Mortgage Planners. And joining us remotely, Joe Sammut, principal broker and owner of Mortgage Architects. Nice to have you both with us. David, I will start with you here in studio. How many people are asking you whether the Bank of Canada is going to cut interest rates again soon? And what should I do? How common is that question coming up?
Everybody's asking. And of course, it's topical. Interestingly, only variable rate borrowers will be affected directly. The bond market, fixed mortgage rates are priced off of Government of Canada bond yields, which are forward-looking. So those the expected Bank of Canada rate cuts that are probably going to ensue in the next, the one we think we'll get on the 24th, and then we think there'll be more after that. That's already in the price. So fixed mortgage rates, if the BoC cuts and sounds as expected, not likely to change much, but if the Bank of Canada goes ahead on the 24th with a quarter-point cut, then variable rate borrowers will benefit soon thereafter.
And variable rates have been above the fixed rates, basically, is the way the math works right now.
That's right. You're paying a premium of about 1% or more now for a 5-year variable over a 5-year fixed. The 3-year fixed is more popular for people going with that option or going that route. And right now you're paying about a 0.75% premium to take a variable over fixed. So you're only going variable if you think that they're going to fall in the next 12 to 18 months.
Okay, and Joe Sammut, what's your thinking on that subject, and what should people think about if they're choosing between things like variable and fixed rate mortgages going forward?
I echo David's comments as well. Anybody that's thinking of a variable needs to have the stomach to be able to withstand any upheaval in rates. They are talking about a slight decrease in prime over time. And as David had mentioned, it's only going to impact the people with variable type mortgages or lines of credit or unsecured credit cards. But fixed mortgage rates, they're very comfortable right now. What I'm telling people is you need to make a decision based on your financial position today, not guessing where prime might go, might not go, and be comfortable with whatever decision you're going to make in this market as we see it today.
All right. And what are some of the other considerations, Joe, that people have to factor in outside of just, for example, to your point, where exactly the exact level of interest rates will be? What are some of the other considerations when you're going out for a mortgage?
When you're looking for a mortgage, individuals need to look at their own personal affordability and their own comfort level. They need to be able to sleep at night. They're taking on their largest investment and therefore most likely their largest liability. So they don't want, in some cases, they don't want the variable impact of a prime lending rate that could go up. Granted, it could come down, but it also has room to go back up. So with that uncertainty, they need to be able to budget their affordability, making sure that whatever mortgage term they choose today, be it fixed or variable, that they can withstand either waiting to see what happens at the end of their fixed term or waiting to see what happens with the variable rate over the next coming years. But affordability is the number one factor. They want to make sure that they can budget whatever term they choose into their lifestyle, and they need to be able to sleep at night. That's the key.
Yeah, and David Larock, the payment story, I guess that's how you're going to be doing the math as you're living your life, like what are my expenses this month versus the kind of payment I'm going to be responsible at that same time as well. But how do you think about that, like the payments that someone can afford, to Joe's point, or what you're comfortable with?
Well, you definitely want to make sure if you go with a variable rate that you can afford for the rate to go up, both from a cash flow standpoint and from a sanity standpoint.
Right.
Interestingly, though, about 2/3 of variable rate mortgages come with fixed payments. So you wouldn't actually have to increase your payment until your rate increased to a level where the minimum payment was no longer covering even the cost of interest. That would be about 1.25 points higher than the rate is now. Given that we have record levels of debt outstanding, both household and government debt, I think a 1.25% increase in variable is unlikely, but still possible. When borrowers ask me about the likelihood of that, I say we'll probably be guarding our vegetable patches with rifles if we go up another 1.25 from here based on debt levels. So possible, but I don't think likely.
Joe, one other thing that has come out, I mean, I think right now it is fair to say there are a lot of Canadians that feel quite stretched. So I'm talking about something that might feel like a luxury to some people. But in an environment like this, where maybe you got sticker shock very quickly, if you can put more of your own capital towards paying down your mortgage, that might benefit you when it comes to your, overall amount of money that's actually going towards the mortgage versus what you're just paying in interest cost. How do you think about that math for individuals?
It makes perfect sense. If somebody has cash flow that allows them the ability to increase their monthly payments or makes lump sum payments from time to time, they're always better off to pay off higher interest rate debt for sure. But to your point, there are a lot of people that are getting into mortgages today and they're finding the affordability is just at their level of, or their comfort level. So a lot of individuals don't have that surplus cash to be throwing toward a mortgage, but by all means, if they do, most mortgages, if not, I would say 3/4 of all mortgages today give people the ability to prepay principal, and it's absolutely wise to do so. If they don't have the means to make lump sum payments periodically throughout the life of their mortgage, at least do something like pay bi-weekly accelerated or weekly accelerated, so that way they can see some acceleration in the pay down of their principal.
David, the conversation that somebody has with a bank, I mean, if you're working with a mortgage broker, hopefully that conversation can be at least somewhat stick-handled by your mortgage broker. But what's the wiggle room on things you can be asking for if you're dealing with a bank on the subject of a mortgage? Whether it's, whether I can pay down some of the principal or other things along the way when you're making this commitment and you're feeling a little bit of uncertainty. How much voice does the consumer have in that process?
If you're negotiating with one lender, particularly a bank, you're not going to get them to change the standard terms and conditions in their mortgage contract. It's basically a rate question. And I think from a negotiating standpoint, looking the person straight in the eye and saying, is that the best you can do for me, is a great way to ensure that you're getting the best deal. It's amazing how people on the other side of the table sharpen their pencil when you ask that question. As far as terms and conditions go, you're not going to be able to negotiate those, but there are significant differences to consider. For example, 5-year fixed rates are very popular with Canadians, and with people expecting that rates are going to drop, if you lock in a 5-year fixed rate today and the penalty to break your mortgage is fair, there may be an opportunity midterm if rates fall by a lot to save money, even though you have to pay a penalty. But other mortgage contracts come with really onerous penalties, particularly the major banks. Their penalties are often 4 or 5 times higher than what other lenders charge. So if you take a 5-year fixed rate today from a major bank and rates drop by a lot, you're pretty much going to be stuck. So you can't negotiate over that, but you can certainly look at alternatives and make sure that you're getting a contract that will serve you well in the future.
Joe, just to come back to you before we wrap things up, one thing we've heard actually for the overall Canadian economy is that because so many Canadians are going to be having this discussion over the next few years, people rolling over. Maybe they were lucky enough to lock in a fixed rate mortgage some years ago, but now they have to deal with the higher rates, that we're going to see this lingering through the Canadian economy over the next couple of years, assuming that interest rates don't come dramatically in a very short amount of time. So how does that get navigated? Just the fact that you're just going to see a lot of people making a big decision steadily over the next couple of years. What are you going to be watching?
That's a very good question. What we're going to see in the next 12 to 18 months is going to be the largest number of mortgages coming due in the Canadian market space ever. One of the things is, to your point, is they're going to be impacted by an increased rate. Therefore, affordability is going to be altered in their lifestyle and in their family. So one of the things they could consider today is to re-amortize their mortgage, going through a refinancing process with an institution and bring their amortization back up to 25 or 30 years to help out with the affordability. That's definitely something that people can entertain today. That is a little bit more involved than just renewing your mortgage, but it definitely gives the opportunity for people to improve their cash flow. And right now, cash flow is probably one of the most pressing things that we're talking to people about, because it's top of mind and they're all concerned about what's going to be facing them at the time of renewal. So re-amortizing is most certainly an option that they can consider.